Hello everyone, Theunis from sunny South Africa in the Western Cape, FX trainer for South Africa for Forex time. Like always, I just want to check if you guys can hear me, if you can see me. Check the technology before we start. I see there's a couple of people, David, Anton, Lasale, Mohammed. Yes, David says you can hear me. So I'm looking for a second person to confirm. Then I can go on. My microphone from my side, everything looks fine. Everything excellent. Mohammed also says you can hear me. Right, guys. Today we're going to talk about the moving average spring strategy. How many people, how many guys that are listening do not know what I'm talking about? Do not know the moving average spring strategy? Can I just have an indication from you guys? Does anybody not know what it means? Anybody that is seeing this for the first time? Okay, David says he's not sure. Right. For you guys, before I begin, I'm going to go to the website, and I want you to be able to get some background. Now, we've got recorded webinars, so I want you guys to, in your own time, to log on to your profile, your My FXTM profile, like I'm busy demonstrating here. When you log onto your profile and you go to education and you go to webinars, you'll see it shows a list of the upcoming webinars. And then it shows you very, very handy the past webinars. This is very nice for training purposes. So I want you to go and look at actually at 4 things. You see here right up top is the moving average spring strategy part 2. Just a little bit lower is the spring strategy, moving average spring strategy. So that's the introduction. But I also want you to go and look at the following things. I'm just going to compress or press Control F to find it. It's a fast way gift. I'd like you to listen to the live analysis, the gift of online trading. That is a little bit of a foundation that tells you why. Mohammed also says he's not sure. So it shows you you get a bit of background on the moving average spring strategy at the previous webinars, and here you get a bit of a background that I give before I normally give the moving average spring strategy. What is this all about? I'm going to recap very quickly, but then I'm going to look today only at the application. So this is where you can get some more feedback. And another one I want you to also look at is the ultimate trading formula. Now, this is a very, very simple, well-defined strategy with excellent money management. That is from our head of department, Prof, we call him, Andreas Tarasinos. So he's going to give you some more there. You can use a variation of it must just be simple, well-defined, your method. This is actually it's still a very good one. It's a little bit earlier, mine is a little bit later. You'll see what I mean now. And if you just go up a little bit, the Fibonacci strategy explained, right? That is his risk management, money management system. So that's his system for entries and so on. Right, so I want you to go and look at all those just to get an idea of how simple this must be, right? So now just to give a little bit of background, just a couple of minutes before we go to the applied part. What is technical analysis? A lot of guys don't understand what we're doing. The market has a language it speaks. It's a wave language, just like light waves, sound waves. If you understand the language, if you understand what it means, then it opens up a lot of opportunities for you. Now, technical analysis is the skill we use to understand the language of the market. So what is technical analysis? We study market action, price for short. It's got other elements as well, but we're not going to look at that now. We use price charts, but the main thing is why. Why do we study these charts? Unfortunately, a lot of guys think it's to look at indicators and to try and make money And yes, it's true, but it's partly true. It's half truth actually. We're looking at it for only one reason, guys, and just for business purposes, for the purpose of identifying a new trend in its early stages. If we can identify a new trend in its early stages, and I'll show you now what I mean, then this becomes a business. Anything else is just entertainment, and for entertainment you pay. I was in that trap. I call it the entertainment trap for many, many years. It was a hobby. It was almost like a game. You pay, right? But when you start doing this properly, when you start getting the skill of technical analysis, you start looking at the charts to identify early new trends in its early stages, then it becomes a business. And you can actually make a net profit over a series of trades. What do I mean by that? Very, very short. Um, this is how price charts looks. Right, this is how our price chart looks. I've simplified it, taken any possible clutter away so you can just see the line chart. So in the beginning, you look at this chart and it doesn't mean anything to you. You just see up and down lines. What we do, and that's why I want you to go and look at the gift of online trading. It gives you some background on what I'm talking about here. Very, very short, we're looking for the early stages of a next trend, the structure of the market. We as traders, and Mark Douglas puts it very well in his book, Trading in the Zone. He says we stay in the ebb and flow of the market. Now what you can see here is the ebb and the flow. You can see how it's ebbing and flowing. So what we do is we try to identify uptrends, downtrends. In a range, we do nothing. But if there's an uptrend and there's a downtrend, if there's an uptrend, there can be a possible after the uptrend, because prices can't go higher forever, there can be a possible early stage of a next trend. That's where we take a calculated risk. First step, always identify the structure of the market. The structure. Second is identify that change in balance, the early stage of a new trend. And that's where our method comes in. So, and then the third stage is from there, we take a calculated risk and we manage that risk. Right, so I'm going to show you all three things, and then we're going to look at a couple of live trades. I'm going to try and get a live trade on different time frames. We're going to try and get a live trade so I can show you how we take the trade, put the entries and so on. And then we're also going to look obviously at historical charts while we're waiting for the live trade to play out. All right. So I see some more guys come joined us. Welcome, Newton. Sunday, welcome. Okay, that's good. All right. So let's jump to the live part so I can show you, so we can do the applied part. All right. Now I've got basically two variations of this. Today I'm going to look at the simplified one. This is how it looks. And again, if you don't know what I mean, if you don't know the setup, then go and watch those other webinars. Then you will get some more background there. So I'm not going to spend time on that now. There's two variations. The first one is more for beginner traders. This is how the template looks. This is how the setup looks. For the template and all the explanation, I've got 4 indicators here. I've got the price, obviously, in a candle format. And I've got 4 indicators. I've got a 34 moving average, simple moving average. I've got a 15 simple moving average. I've got a momentum, and I've got fractals, right? Now, the reason why I simplified this is that, again, the problem is people start looking, instead of looking at the price structure, they start looking at the indicators. They start actually relying on the indicators, and that's just a recipe for disaster. We don't rely on indicators. They're all lagging. The indicators are just there for confirmation after we have made sure that we can see the structure of the market, and we are sure the market it's an early stage of a next trend, and the market is giving us permission to actually trade. So just to confirm, those are the areas. We see the structure first, and then we see where the structure is broken. The balance between buyers and sellers is broken. We understand what this means, the market means. And then this is the early stage of the next trend. There the market will give us an opportunity using the wave structure. That's where I want to see the candles. I'll show you now, to take a calculated risk. Nowhere else, guys, nowhere else, especially in the beginning when you are learning this language for the first time. As your skill gets better, you can take multiple trades. There's other opportunities as well, but this is always the foundation of your business. And I call this slow trading. You must get to know this, like learning to walk. You're going to walk slowly, getting your balance first. As you get better, as you can walk without thinking, as you've practiced it so many times that it's in your non-conscious, so many of the actions in your non-conscious, then you can start jumping and skipping and do all sorts of things. That's what I call fast trading. Slow trading, you must master first. You cannot drive a car if you haven't learned how to drive. Even if you've got a car, if you don't know how to drive, this is slow trading, then you will just damage your car, and you can get hurt in the process. The car is like trading, the trading business, and your skill of driving is what will unlock the opportunities with this business opportunity. Your skill in driving is what's gonna unlock the opportunities of the car, the potential of the car. Without the skill, you will never drive the car. You'll have to rely on other people all the time, and that's not what we want. All right, so this is what we're going to do. We're going to look for these areas. That is all that the method must help you to do. You see the structure, and the method helps you to see, to determine entry and exit points there. So let's go look at a few. But you can see here, this is the old template. You can already see here was an uptrend. Looking at the price, forget the indicators at first. Looking at the price, and you can see it's breaking through here. It has not given us a signal. It must go down, go back up, and then go back up here. For instance, here was a good one. It's a break, a pullback, and there was a good entry, right? So here's nothing yet. I just want to, before we look at the more live ones, try to find the live one. This is the simplified version of that. And I did this for a very important purpose. It's because I see people get stuck on the indicators, right? What I've taken away here is the momentum as well as the fractals. What I've left is just, I've taken the candles away as well. No clutter, guys. I've left the 15 and this 34 moving average for the purpose of giving us almost like a dynamic trend line. So we don't have to draw it in. Because remember, as we said, that we want to be able to identify trades at the speed of light. We want to open a chart and within 2 or 3 seconds see is there an opportunity or not. And if there's not an opportunity, we go to another time frame or chart. I'm going to illustrate for you guys now. I've got my normal setup here. So most of that 14 that we use for the Forex time signals. I like those ones, so that's the 14 I look through. So this is the simplified version. So why did I take all this thing, the indicators away? Because in the beginning, especially in the beginning, they are just clutter. If you start looking at them instead of the price, you don't understand the structure, that we're looking at the structure and the early stage of a next trend, then you just get lost between all the indicators and what they're saying. Right, so this is what this chart looks like now. Now, as you can see, there's not any pullbacks here. So what we're looking for is the following. Let's see if we can spy one. Right here, we've got a nice uptrend, right? So within 2 or 3 seconds, I can see there's nothing for me here, right? Not with the spring method anyway. For the spring method, what we need is we need a breakthrough through that trend line. We must break the trend. And there our moving averages helps us. And then it must pull back. And we're going to use the wave structure of the market. I'll show you now. And then when it starts going down, we're going to use our guidelines. In the first version, I used a normal 1-to-1, 1-to-2 risk ratio with partial profits, but I've changed that in the simplified one to the much more powerful Fibonacci extensions. Right. Let me just remove that middle one there. Right, that's what we want. We want our entry line is the 100, our zero line, our stop loss line is the 0, and then our extensions there we will take partial profit. Right, that's what we're looking for. And if the price goes past that, we engage, and that's where we take partial profit, and then another partial profit, and then the market run. Right, let's get back to scanning. So what I'm going to do now quickly to illustrate for you, I open my charts in the morning. And I'm looking for an early stage of a next trend. 1 or 2 seconds, nope, this is still a nice uptrend busy going. Uptrend busy going, done. Okay, what happened here? There's a nice breakthrough. I like it. Let's go to the candles. The first step is see the structure of the market. Second step, now I want to see the emotions. Right, there was a possible entry, and there might be another one. It breaks through 34, it pulls back. There might be an entry. Right, let's evaluate. Was this really an uptrend? Any of you does not know what the uptrend is, very quickly, also you'll get in foundation on that gift of online trading. An uptrend according to, and we use the definition of Murphy. He's got a book which is called the Bible of technical analysis, or one of the Bibles anyway. The technical analysis of the financial markets. There he says, and that's the, no, sorry. That is technical analysis. That's the definition of technical analysis. We use the definition of Charles Dow, one of the founders of the Dow Jones. And our definition of an uptrend is 2 consecutively higher tops and 2 consecutively higher bottoms, and it breaks the second one. Let's look at an example here. Lower bottom, lower, bit of higher top there, lower bottom, lower top, lower bottom, lower top, lower bottom. The moment it breaks the second lower bottom, then according to Charles Dow, it's a downtrend. If it's a trend, down is obviously 2 consecutive lower bottoms, and up is 2 consecutively higher tops and bottoms, and then it must break through past. It must break past the second one. All right. So was this a decent uptrend? One, not a nice pullback there. Not a pullback. This is not a uptrend, a decent uptrend. And I don't like spikes anyway. Lots of spiky movement there. Right, so no, I'm not going to choose this one. Next one. Nope, it hasn't broken through 34 yet. Ah, excellent. It's broken through 34, but has it pulled back yet? Nope. If this is a consecutively higher, here you can see it's a top. There's a higher top, higher bottom, higher top, higher bottom, and then it zooms past there, it becomes an uptrend. The reason why we want this compression, this demand pressure, or this demand momentum here, is there's a lot of guys buying. When they go past that point, the second top, we know there's a lot of buyers committed to this market, and we know the market cannot go higher forever. We know this. At some stage, the guys won't be able to, and they'll start taking profit. Even the buyers take profit, and then the early stage of the next trend gives us that. That's why we talk about a spring, the compression, demand compression here, and it wants to release. So we use that first release, that early stage of the next trend, to take our to get to our first profit. We use a high definition or a high probability risk management, management to take some profit when the market goes in our favor, to get our risk less, to make the mental pressure less. Right, so yeah, we've got it, but it hasn't. It breaks through, but it must pull back now and then go before we look. So no, nothing yet. Here I've got a trade in on a different time frame. Yes, still a downtrend forming. Still a downtrend forming. Nothing for us here. The trap that many people fall in is after they see this, then they still linger on the chart. What are you lingering on the chart for? There's nothing there. There's no, I call it the golden spot, the early stage of a next trend. That's what we're looking for in this method. Right. No, nothing. Bit of an uptrend, but it's still busy there. It's not really an uptrend. It's more of a range there. The reason why I keep it on a line chart is I just want to see the structure, guys. I don't want to be distracted by anything. I need 2 or 3 seconds to see, is there an opportunity here? Analyzing the chart at the speed of light. That's how our head of education, Andreas Talasinos, calls it. And it's very, very wise, because that's what the entertainment trap is. You linger on the chart, you're looking for something that's not there. Obviously, it's not there, so we jump to the next one. Still an uptrend, still above that 34 moving average. It's broken through the 34 moving average. The question is, was there a downtrend? Was it 2 consecutively lower bottoms and lower tops? If you look at that, yes. So this might be an option here. No, definitely not with that gap. Technically speaking, if it pulls back now and then it starts going up, then we can look at a possible setup here. But there's a lot of warning signs here, guys. Gaps, warning signs. Long candles, warning signs. Normally I like a nice structure of the market. So nope, not going to go for this one as well. This one is broken through. It's just the British pound, also the British pound here. We can quickly see there is also the same warning signs. In the end, what we do is when you look at the ocean, the market is like the ocean. Like there's waves being generated. There's no conspiracy theory like a lot of guys think. The markets are too big. Perhaps in the smaller markets you get conspiracy theories with small or big guys move the markets. But the Forex markets especially is huge. There's no guy big enough, no firm or group of people big enough to move it. So it's like an ocean. It's just waves being generated by supply and demand. Right, and we look like when you sit on the beach, you look at those waves coming. We look at those waves coming. And then you want to surf those waves. You respect the ocean. You learn how to swim. And you go and learn from a surfer or whatever, and then you practice, right? It's the same thing with this. And if you've got the skill, when you respect the market, you listen to it, the ocean, then you can actually play in the waves and enjoy yourself. If you respect the market and you learn the language of the market, then you can play nicely. You can play in these waves if you know what you're doing. So right, another warning signs there. Nope, a nice downtrend there. Uptrend there, still busy, hasn't broken the 34. Now DAX might break it there. Let's see if that was a uptrend. A higher top, higher bottom, higher top, higher bottom, but not a higher top. Nope. So we stay away. Not enough compression there. If we compare it to spring being compressed. Charles Dow, 2 consecutive higher tops and bottoms. Right. So now I've gone through the 4 hours. Let's quickly go through the 1 hours to see if we can spot an opportunity. On every single time frame, there's a structure, and the structures differ. Part of the entertainment trap, it's something I was trapped in for a very long time, was using different time frames to try and get trades. It's just a trap, because in the end you take you bring in so many clutter, so many variables that you have decision-making fatigue. I know perhaps some guys can do it, but for me it was always a difficult thing, and I've got many testimonies about that. Right. So what's nice about this structure, if you see the structure in every single time frame, there's a structure, and you take your trade, you look for the trade, you identify it there, you take it there, you identify your method shows you the entry, and then you manage the risk there, at least until you've got some profit. Right, let's see. Beautiful, guys. We're a bit late for this one. Here you can see a beautiful uptrend. Doom, doom. It broke through, it pulled back. From that point on, I want to see the candles. So let's see. There was a beautiful one, but we missed it. Right, so it went down, it broke through our 34, broke that structure of ours, pulled back, and it went. If we took that trade where we used the let me zoom in a little bit. This is a good example. So the market broke through there. At that point, some buyers came in. That's our point where, because it's a lower bottom, where the uptrend has been broken. There's something happened there. We don't care what happened there. But something happened there. That's what's nice about the language of the market. We can see this is what people are doing, not what they're saying they will do, but what they've done and what they're doing now. That's what the price reflects. So here it broke through. The buyers tried to take it up. They couldn't take it up the moment it started going down. If we were there, we put our guidelines in. This is a simplified simple moving average, or moving average spring strategy. And while it's down there, we put our stop orders in, and we see what the market's going to do. In this case, the market triggered it and didn't take our first take profit, and still lingering there. As long as the market continues making lower bottoms, lower tops, lower bottoms, lower tops. As long as it continues making lower bottoms, lower tops, we respect the structure of the market. We stay in here. We don't mess with the things. It's still a possible downtrend, but as soon as it stops making that, if it doesn't make a lower one here, it makes a higher top there. Then it means the structure, it's not a early stage of a next downtrend in this case anymore. And what are we looking there for? Remember, what is technical analysis? We look at the charts to identify the early stage of a next trend. When there's an early stage of an next trend, we take a calculated risk, and then we manage the risk. If the structure, if the market changes here, no more lower tops, lower bottoms, very simply, then this might become a range. We're not sure what's going to happen, we get out. This is the nice part about getting in at the early stage of the next trend is the market and taking a calculated risk. Too much money, too much percentage of your account on a trade causes a lot of mental pressure, and that's where the emotions come from. So we don't want emotions, so we trade a sleeping level, as they say. we use a little bit of our money, take a calculated risk, and we let it go. We let the market speak. Yeah, the market might be saying goes higher, but it isn't, and we don't care. We're going to allow this one to do what it wants. If it breaks up your past here, we'll just take it out. If you're taken there with a small loss, if it goes up, doesn't go past and continues down, then we let it go. Then it will touch our first one. We take our first profit there, partial profit, second partial profit, and then our third partial profit. Right. This is a good review. Let's get back to our analysis. This is not a good current trade, right? We missed that one. Let's go to the hour here. Nope, nothing. Broke through a little bit, but then it started making higher tops again. That is a range. The professor, that's what we call our head of the education, is a very clever guy, wise man, a lot of insight. He calls this he calls ranging killing fields. That's where people blow their accounts. We don't know what's going to happen there, guys. And the most important part for me is what happens in a range is there's a lot of buyers and sellers on the sideline. If there's a lot of buyers in the market, it's an uptrend. If there's a lot of sellers, more sellers than buyers in the market, it's a downtrend. If it's a ranging market, then a lot of guys are sitting on the sideline and nobody knows what's going to happen. If there's an uptrend, people are buying. Price cannot go higher forever. At some stage, it will go lower, and that's where we take our calculated risk. And it's exactly the opposite with a downtrend. Lots of sellers, the price can't go higher forever, and that's where we take our calculated risk. Right, so this one has no opportunity as well. Let's go on. 1 hour. Nope, nothing happening here. Looks like a little range here. Remember, and that's something I want to say very, very clearly. There's so many opportunities, guys. Yeah, it's not necessary to take ones that we doubt. We're looking for a beautiful uptrend, a beautiful downtrend, and a reversal of that uptrend, downtrend. That's the early stage of an next trend. That's what we're looking for. Can we see a beautiful uptrend or downtrend here? Nope. We just see perhaps a little one, but not a lot of compression. We want that spring. That's why I call the method the moving average spring strategy. When there's compression, the spring is compressed, it wants to release. There's a lot of release power there, it wants to release. We never know how much it's going to. That's not our business. Our business is to make money. We take a calculated risk at the beginning stages of a next trend. That is what our business is all about. What causes those swings? It can be many things, and even if you look at the news and you pay very much a lot of money for the news, you will never know exactly, and you'll always know it after the fact. So we're not going to waste our time with that. Okay, obviously nothing here. Let's look for another one. Beautiful downtrend in progress. Nothing for us to do there. Beautiful uptrend in progress. Nothing for us to do there. Uptrend, and it's busy making a range there. Right. So let's just look. It started making a range. Higher top, or there was couldn't get a higher top. It was a bit of a lower top. Then it was a lower bottom, but then it made a higher top again. And then not a lower bottom. That's the characteristics of a range. So danger zone. Right, let's go and look. Danger zone. Was a nice uptrend break. Didn't break through very far between the below the 34. The reason for the 34 there is if there's a lot of momentum like that, it's dangerous to trade there, guys. It's dangerous to trade above. We want our reversal. We want our early stage of an next trend to be around about with the 34, so we know it's sustainable. So long candles like this happens during news times when there's a lot of uncertainty. People don't know what's going to happen. Buyers and sellers taking it high and low. That's very, very dangerous. That is not something we want. We want the consistency of the market. We want those waves to be nice and consistent. It's not a lot of people have got the skill to surf in tsunamis in the real world, and this is tsunamis in the surfing world of the language of the market, the waves of the market. So I suppose you do get guys that can surf there and and survive, but especially when you're beginning to learn, then you need slow trading. You need to practice your skill slowly and get your cash flow going. That's the purpose of these webinars, of all the training we give you. We want to teach you the language of the market so you can get your cash flow going in this business. So understanding the language of the market. This is just a danger zone. Let's get back. I see there's a question. Mohammed said he's glad to attend my webinar, learn about the candle strategy. Okay, this is not a candle strategy, Mohammed. This is I call it the moving average spring strategy. I use the candles only when there's an early stage of a next trend. Let's see if we can find one so I can show you again. At this stage, my first step is always just seeing the structure of the market. And let's see, was there a downtrend? It's broken through here. That's when I want to start seeing the candles. Was that a proper downtrend? 1, 2, never went lower. A little bit higher there was lower. Let's say for interest sake, this is it's not a very good one, but I like a lot of compression there with my trend. I like a beautiful trend. But just for interesting sake, it's only after it breaks through, when it's an early stage of a next trend moment, that I want to see the candles. The problem with candles for me is a lot of people read books about candle strategies and so on, and then they want to trade candles anyway, right? The proper area to trade is in those areas, and that's where the candles, the value of the candles comes to play. That candle formations comes to play. Shooting stars, hammers, and these things, when they occur there with proper wave structure, then we use them. A lot of guys just want to jump in and out of the market anywhere they see a proper candle, or they see a candle, and that's dangerous. So candles in its own is not really gonna help you, but as part of technical analysis, and this is what technical analysis is: identifying the structure of the market, looking at the price chart, identifying the early stages of a next trend. Those areas there, yes, we can use the candles to identify this wave structure to tell us where to enter, where to put our stop loss. And in this case, if this was a good one, not a very good one, but if this was a good one, there is where the market is telling us to put our stop loss and our take profit, or our entry would be there. This one is obviously too late, but our entry would have been there if we were going up here, and there's where our stop loss is, and there's where we take our first profit, take second profit, and third take profit. A lot of guys tell me, no man, I want to make a lot of money with each trade. Now that's a bit of a dangerous thing, and actually for me, that was the last puzzle that fell into place before I started becoming consistently profitable. I also wanted to make a lot of money with every trade, and the problem is just that there's a very low probability the market will go, give you a lot of money, but there's an added danger there, which I never realized until I learned about the high probability money management or risk management system. If you use a low probability system, you want a lot of profit with everyone. While this thing is moving in your favor, there's a lot of mental pressure. When are you going to close? When is the market going to reverse? It might reverse anytime. That extra mental pressure is very, very dangerous. That's where the emotions come from. then it's very difficult to respect the structure of the market and allow the market to give you what it wants. In this case, what happens when we use a high probability risk for money management, what we do is we know there's a high probability the market, especially when there was a lot of compression, there's a high probability the market will go to our first take profit. We take partial profit there. We remove most of our risk. We normally take 50% of our profit there. We remove 50% of our risk. We have some profit. Then there's almost no risk left. In fact, there's only about 20% of the original risk left. That means it's easy to let the market play out what it wants to give us. Sometimes the market is very generous. It wants to give us a lot. Sometimes it's going to turn around and take us out with a small loss in that case. Or sometimes it just goes to our second one and starts turning around. Now, remember what we do. We have the skill. We are building the skill, practicing the skill of technical analysis. That is understanding and using the language of the market. To stay in the ebb and flow of these markets. We don't try to tell the market what to do. We just listen to the market. We move with the market. And we never know what's going to do. I don't care if you're the best analyst in the world, the best economist in the world. There's just too many people, too many variables in these markets. Nobody knows what's going to happen, even 10 seconds in the future. It's not our business to know what's going to happen. It's our business to listen to the market, to stay in this ebb and flow of the market. That is as simple as I can put it, and I hope you understand. So, right, so this is just an example. I like to mix the lessons. You'll see there's lots of things while we're practicing here, looking for opportunities. There's lots of things that I mix in here. What actually happened here, let's see, is there was a downtrend, and I was looking for a possible entry there, but nothing happened here, so I can take this one out. It's busy. Just the downtrend is continuing. So there my stop orders was. Okay, so there's just a beautiful downtrend continuing there. It looked like it might be the beginning of an uptrend, but it never went. It never made a higher top than the previous one, than that one. So I left it, and now I'm taking it out. Right, so a beautiful downtrend. No opportunities for us here. Just a ranging market there. Here also, nice uptrend here. It broke through, it pulled back. Let's see what happened there. It broke through, it pulled back. There was a good entry. Another very, very important thing I want to say. It was actually a pullback, so entry would have been there. This is a nice example. It went down, pulled back, it engaged us, and it stopped us out. All right. So a lot of guys would then say, no, this is a bad trade, we had a loss. No, guys, it wasn't a bad trade. These things are going to happen. We don't know what's going to happen. We took a calculated risk. We saw the structure of the market. We took a calculated risk there, and we protected our account. That candle up, nobody knows at that stage. It could have just shot up and gone further. We didn't know, so we took a calculated risk. We managed our risk. So that's a good trade, even though we were stopped out and we have to wait now again. We wait for another wave. A good trade has got nothing to do with a profit or a loss. It's got to do with, did you respect the structure of the market? First there, it broke through. Then we put the candles on. Did we respect the wave structure of the market? Did we take a calculated risk? And then did we manage that risk? So a lot of guys blow their accounts because they don't respect the structure of the market. In fact, this is an excellent example. I've had guys tell me that something like this happens, and they say, no, it's never going to happen again. They will not use a stop loss anymore. They will monitor it. And then what happens is they take a calculated risk here, and the market spikes up, and now they're too afraid to close the trade. They hope it's going to go down, and then they lose a lot, of their accounts. So with every single trade, the definition of a good trade, guys, will always remain: we respect the structure of the market, uptrend, downtrend. We respect that shift in balance, the early stage of a next trend, the wave structure we use to take a calculated risk, and then we manage that risk. So, and we use a high probability risk money management system. Right, I see there's some questions here. Okay, Mohammed, so we're not using candles, just on our second step. And then, okay, Sanji asked a question and has left in the meantime. Please tell us the moving average period. This is the 34 simple moving average, and this is the 15 simple moving averages. And so, guys, we are not looking at the crossing, right? The crossing means nothing to us. We're looking at the price. We're looking at the price structure here. I'm looking for a nice lower, higher tops, higher bottoms, and when it's broken, there was a bit of a movement there. If that is broken, we look for a next wave structure, a possible early stage of a new trend. That's what we're looking for. If you go for moving average or for the crossing of the moving averages, then I can promise you only one thing, and that is that you will lose a lot of money because it's delayed. It's not following. Then your eyes is on the moving average, not on the price structure, and then you'll be either too late or too early. Some you will catch if it's a very good uptrend, but in a trending market, then you will wipe your account. That's a problem with the moving averages, with looking at any indicator for that. All right, Newton asked, is my Fibonacci in default mode? No, definitely not. I'm going to quickly show you. This is not the default mode. The extensions is the same. I'm going to quickly show you how to do that. That's very, very useful, guys. Let me just copy that. This is how the defaults look. Now this is the Fibonacci retracements as well as the extensions. We are not going to use the retracements. Not in this. We're using as guidelines. So what we do in this stage is we open, we double click, we select our Fibonacci tool. We go to properties, we delete the retracements. We only want the 0, the 100, and then the extensions. But now this is a very nice thing to do. I put in a couple of spaces, 5 spaces or so, and then I put this is a nice shortcut to put the price on that guideline. It's going to help you when you put in your orders. That is a percentage sign, a dollar sign. So I do that for all of them. This webinar has been recorded, so if you later want to see this again, you can just email me and I'll send you the link. Not all the webinars are put on the website, the FXTM website, but they are for a couple of months anyway. They are on the GoToWebinar website. So I'll send you a link to there if you want to check this again. And then what happens when you press OK, then this is your guidelines. This is where we're going to put the 0 is where we put the 100, sorry, is where we put our entry. And what happens is, let me show you. We click on our tool. We click to where our entry would have been. We drag it to where our stop loss would have been, and we let it go. And then it automatically draws in for us the Fibonacci extensions. Right. Let's move on in our hunt for good trades. Right, same thing. It was a nice, higher tops, higher bottoms. When it broke through there, we start looking at our candles, because then we want to see that wave structure. It broke through, it pulled back, and absolutely beautiful little gem of a trade there. The only spoiler might have been these big candles, but it wasn't so big, not the same as those ones. There was some structure there, and that's a very nice trade. You would have had your first take profit, almost no risk left. Second one, then you've got a net profit, although you don't move your stop loss. And now we're gonna see what the market does. The moment the market does not make, here was a lower bottom, lower top, lower bottom, and now it's buffering a bit. If it doesn't make a lower bottom, but it makes a higher top and it moves again, then I'm going to take whatever profit is left there. When this structure is broken, and that's why the 34 moving average is such a handy one. When this structure is broken, then, and it's not a downtrend anymore, then I want to take the rest of my profit. Right, the nice thing about this method, guys, is that it takes you very, very quick to see possible opportunities. And if you practice this, let's see what happens here. Not a good uptrend there, so nothing. If you practice this, then it becomes very, very easy, very quick. You scan through your charts, you see opportunities, you take the calculated risk, and you go on with other things. And you monitor your trades every 3-4 candles. You don't have to sit in front of your screen the whole time, especially if you're trading a little bit higher time frames. So what do we see here? Lower time frame, or lower tops, lower bottoms, and a bit of a range. So no, I don't really like it. Not lower tops, lower bottoms, so that's a ranging thing. So nope. Let's see on the oil chart. Broke through there. Nice uptrend there. Beautiful. Let's see what the market is saying. Aha. What do you see? Beautiful uptrend. I see it broke through. It's pulling. It pulled back a little bit. The structure of the market is intact. I like it. And there is a possible opportunity. Right. Now I'm going to show you guys. Okay, it's not perfect. It's not going down, but at least it looks like it. So now I'm going to demonstrate to you guys how we're going to enter a couple of trades. How we're going to enter a position here, or trade. But it's called a position. I always get confused. What is trade? No, it's what is a position? What we want to do in the sense of is we want to open one position here, right? But we're going to split that one position into 3 trades. This is a 1 hour chart. There's enough time for us. It's only on the very small, like the 1 minute and 5 minute perhaps, that you can actually take one position, one trade, and then manually close these trades. With the higher positions, there's a much more easier way to handle this. Right now, the guys asked me about lot sizing. Lot sizing, I'm not going to talk about that at this stage. The lot sizing I want you to do is simply, this is crude oil. I think the least we can use is 0. Let's see if we can do that. Okay. No, the least we can use is 0.4 for this one. Why would I want to do that? Obviously, it's a demo account. 0.04 is I want to be able to split this trade into 3. 50% I'm going to take here, take profit, 25% and then 25%. Right, so if I take a position, if this was a normal currency pair, I would say 0.04. We're practicing, guys. We're focusing. We are learning the skill of technical analysis. We're learning to understand this language, to listen. We don't worry about money now. If you haven't got the skill, the money will never come. If you've got the skill, you master slow trading, the structure of the market with the calculated risk and the risk management, then the money will come. You don't worry. It's a net profit over a series of trades. So what we do here is I want to split this thing in 0.04, 50%. I'm going to take 3 positions here, or 1 position, 3 trades. So my total position is going to be 0.04, but I want my first take profit here, and then a third one, and my first one here, then my second one, then my third one. So what I'm going to do now is this is my total position. Now I'm going to split this into 0.2. And I'm going to put my first stop order here. Because I've changed it here, there's a nice shortcut available for me, a sell stop order. And I put it at its right place. Now what happened here, guys, is I can now put my stop loss there. What's happening there? I can put my take profit. Oh, no, sorry. This is a stop order. I must put it in manually, right? The reason why I didn't want to take it is because I put it above the current price, and it's a stop order. Okay, now I want, and I'm going to change this this trade. I'm going to put a stop loss that is there, and then a take profit that is there, right? So remember, it's one position that we're going to open. It's one position, and we're going to split it into 3 trades, right? Oh man, 1 trade, 3 positions. Yeah, I think that sounds better. What do you think? Right, 1 trade, 3 positions. The total amount of risk we're willing to take, we're practicing, is 0.04, but we want to take profit there 50%, there 25, there 25. So I've put my first one, my 50% position there, and now I'm going to put a second one there. And now a third one there as well. right, and I drag them to the correct place. So we've got one position there, 3 trades. One trade, 3 positions, whatever. Okay, so, and that's the full amount that we are going to risk there. But now we want to, the stop losses are going to be there of all 3, but this first 50% one take profit is going to be there, then the second one, then the third one. That means, guys, when we have changed this, let's just go and change that one, and there the guideline proves its value. So I can just go and modify there, and I can put the stop loss there is 60.58. I'm going to copy that so I can just paste it with the other ones as well. And then my take profit there is going to be 59.92. And there you see the confirmation. Duck, duck. Right. Now the second one, that means the whole trade is managed on its own. We only have to look every couple of trades to see what the market is doing. It's 59.51, second one. Jack, it's there. And the third one, paste, and 58.84. Jack. So what have we got now? We can just leave and look 1, 2, 3 candles later. Either the market's going to breach that, then we just take out the trades, nothing's hurt. Or if the market passes below that point, let me zoom in a little bit. If the market passes that point, we are willing to take a calculated risk, and there's a high probability because of all this demand compression here that we will reach at least that point. There we take 50% automatically because we put in the trade. The first trade that the first position where half of our profit's gonna be taken, right? Then the risk is halved, but also we have some profit. Then only 20% of the risk is left, and if it reaches that one, we let the market run. If it reaches that one, then even though we haven't moved the stop loss, we have a net profit, and then we will leave it until it gets there. Or if the market turns around, if this market structure, let's say for instance, just to illustrate, if this goes down, up, down, perhaps taking our first one, up again, down, and takes our second one, and then the structure changes and starts doing this. There I will take my rest of my profit. There's another possible trade, and there I will take the first profit, the rest of the profit that's left there. Okay, let's jump. We'll see what happens to this one. Okay, now what we're going to do is we're going to jump to another time frame. Okay, let me see. Before I jump again, I'd like to see what the people say. Newton, yes. Can all you guys, did you see what I did with the Fibonacci? If you don't, then you can just email me and I'll send you the recording. You can check it again. Joseph says that he'd like the recorded part, was unable to pay full attention. Please email me, and then I will send it to you. I'll put the email up a little bit later. Right, we've gone through a couple now. Let's jump one lower, guys. Still looking for another opportunity. This is a 30-second chart. Right, we've got a trader here already. I'm going to put in a second one. You'll immediately see the structure again changed. Every single time frame, guys, has a different structure. So when we respect that structure, we take our calculated risk here. Here, for instance, was an uptrend, and there was a nice start, a break, early stage of the next trend. There was a nice possible position there, either there or there. Right. Of course, they do not always work out. That is part of the average of our business. Any business that are not willing to pay overheads, if you've got a supermarket and you're not willing to pay your rent and your salaries of your staff and your suppliers, you won't have a business. The overheads in our business is the calculated risk we take, and the fact that the market sometimes that structure is broken. Like for instance, let's say you entered there. This is actually a good one. Let's say you entered there. It's not a good one because it's below the one, but just for example's sake, you were entered there and you were taken out. That is part of your overheads. That is still a good trade. You respected the market. You did everything right. A bad trade on the other side, on the other hand, is nothing to do with a profit or a loss. It's whether if you don't respect that structure, if you don't listen to the market waves and take a if you don't take a calculated risk, if you trade with too much of your account, the mental pressure is too high. And then if you didn't manage your risk well, if you didn't take partial profits, you wanted a lot of profit, you're using low probability risk management, then that, I don't care if you made a profit or a loss, that is a bad trade. Right. And the way we survive in this business is consistently taking good trades. That's how we make a net profit over a series of trades. We don't try to predict the markets. We are just actually looking for what the market is telling us. So let's go back. Nothing here, guys. Let's see if we can find one more before we finish. Nothing here. Just a downtrend busy playing out there. Beautiful downtrend going down there. Beautiful one. Downtrend there. Oof, movement. Nope, market jumping around there. We're looking for a beautiful uptrend or a beautiful downtrend. There was a beautiful downtrend there. Let's see what happened there. This also happened, guys. It never gave us an opportunity. Now, if you sit on the wave or on the beach and you see the waves, if you miss one wave, so what? There's more waves, right? We take a calculated risk when it's a good wave. We like it. And if there's no good wave or we miss it, we just wait for the next ones. We don't have to be in the market all the time. That's how people blow their accounts. So this one is just didn't give us a nice pullback, a wave structure where we can take our calculated risk in the early stage of this next trend. So we leave it. Nothing, ranging market, killing fields, another killing field, dangerous places. Nothing there. Market went up. Let's see what happened here with the emotions. It broke through a little bit, went up. You could have, it's past the 34, you could have taken a calculated risk there. If it was triggered, I don't know, might have been triggered. There's a good chance it was being triggered, and then it took you out. Another overhead payment there. Okay, this stage is busy ranging. Okay, let's see. Nope, nothing. Nope, nothing in this time frame as well. Nope, nothing. There's a saying from Warren Buffett. Oh, beautiful downtrend busy forming, where he says that the markets are instruments for transferring funds from the impatient to the patient, right? So if you're impatient, if you're trying to force the market to do something, you're not listening to it, you're not moving with it, then you end up paying. So sometimes there is just nothing, guys. Let's see. Let's sweep through the 15 minutes very quickly, and I'll show you how quickly we can go. No. 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 Can you see? There's no opportunity here. Within 2 or 3 seconds, guys, we can see if there's an opportunity. Nothing there. This is the thing you're going to practice. You sweep through, and then depending on which time frame you are constantly monitoring, or you want to check, you can only look 2-3 candles later again. Nothing. And if there's nothing, there's nothing. If you fall into the trap of staring too hard at the charts, then you will convince yourself there's something. And that's the trades where you afterwards say, what did I do? Why did I take that trade? Let's see. Nothing. Nothing. And oh, that was a nice one there. There's a downward move. down. Aha. Oh, this is interesting. This is actually a trade in the opposite direction. On the higher time frame, we've got a possible break up, and if it goes down there, we want to take that one. But now what do we see on the lower time frame? Right, we see a downtrend, we see a break, we see a pullback, and we see a possible up. So in the beginning, when you're slow trading, I would not take this, but it's quite possible when you get proficient to have two opposite trades in the same currency pair. Why? Because we respect the structure of the market here. What do we see there? We see a possible early up trend in its early stages. So if you would take that one, that is where we would put the orders. And if it breaks there, takes that one, obviously then the higher time frame structure is broken. We take away these orders. It's not the same as some guys do with the channel, where they put a buy and a sell order, opposite sides of the channel. This is not the same. That is not respecting the market structure. Channel is a ranging market. Nobody knows what's going to happen. Lots of guys sitting on the sideline. There's no compression. There's no spring power there. This is totally something different. This is a market structure we're respecting. This is a wave structure we're respecting. Time is unfortunately up, so I'm not going to take this one. But that's how we trade, guys. That is what trading is. Technical analysis, looking for the early stage of the next trend. You have a simple, well-defined method. You don't need complex stuff with lots and lots of indicators. We just have indicators that is useful to you. And then lastly, very, very important, high probability risk management. The market is never, the chances the market is going to make you rich consistently over every trade is low probability. The fact that if it's a beautiful up and down trend that will move in your favor for a while, whereby enabling you to manage your risk, if you take partial profit, that's a high probability. So that's why we have a high probability risk management. Right. Yeah, Inatan of Joseph, I'll send you that just for in case, because I'm going to be busy now. Just send me anyway email. This is my email. Here's my, let me just go get back to the presentation screen. There's my email. Please email me, any of the other guys if you want, even if you're listening later via recorded message. If you have any questions, please email me. That's what we call the learning process. You ask questions, you get the answers, and then we discuss it. You discuss it, and then you learn. That's how you get to make mistakes. The mastery process, you try something, you make a mistake. Making a mistake, trying something is much, much better than never trying anything. That's the biggest mistake you can ever make. You try something, you learn, and you grow. Right, that's how you get, you master anything, how you grow in anything. Right, let's see if there's any other questions. Our time is up. Sidwell's asking, so can I watch the video? I lost time. That's good. Not good, sorry, but you can just email me and I'll email you the link. It normally takes about 2 hours for this webinar to finish saving and all the things that are done in the background, and then I have access to the shortcut. And if you emailed me in the meantime, then I'll just send you the link for this. What's going to happen is if you click on the link, it goes to the webinar page, and you're going to have to put in your name, your surname, and your email address, and then you press register, and then the webinar will start playing. It doesn't allow you to download, but in that way you can listen to it, and then you can also scroll if there's areas you're not interested in. For instance, if you only want to go and watch the Fibonacci tool, how it works, you just scroll to where it is, so you don't have to watch through the whole thing. That's very, very handy. Right, guys, it's been nice talking to you, and I'll see you Friday again. I've got another webinar on Friday. We'll talk a little bit more about the mindset, the trader's mindset, the psychological part of trading, which is very, very important. Okay, have a nice day. Goodbye.